5,500 number, but it doesn't necessarily reflect how you think the year is going to end. Are you going to take a look at your year-end targets now?
We are, Carl. At the early December last year, we thought S&P could reach 5,200 this year, which at the time was almost a 20% gain. We've obviously moved well above it, and the fundamental picture to me looks stronger. I think earnings next year we originally thought would be 260 for 2025. It's probably closer to 275. I think the war on inflation has been meaningfully better in terms of progress. I know there was a lot of dispute, but I think the last two inflation reports and the fact that 55% of inflation components are back to pre-pandemic levels means inflation is really going to fall like a rock. These are factors that give us comfort that multiples can expand. And so I think 5,200 is clearly too low, but I don't know how much above 5,500 there is into year end. So I think in a couple weeks we'll be addressing that.
You actually use a graphic of a falling rock in your charts to describe elements of inflation that you think are dropping. You said we're beginning to see insurances a break, waiting for shelter to follow suit. Some of your forecast, Tom, on new cars and used cars, do you actually think we could see that kind of deflation?
Yes. I think, one thing to keep in mind is that there's almost 290 million cars on the road today. So when, used car prices fall 10%, and they're continuing to fall, that's a meaningful amount of disinflation and may be painful for people who've borrowed money to buy cars. But that is also, saving people who are buying cars. And so I think there's a lot of goods disinflation in the pipeline, and especially with new cars, inventories have really been picking up. The CDK cyber security hack might sort of disrupt it short term because there's a shortage now of new cars available, but I think the trend for new cars is also lower.
So, Tom, what happens to earnings estimates in this environment? I mean, I get that it's good for the market if inflation falls and the Fed starts cutting rates. Maybe that trumps everything. But if the economy starts to really weaken and these forecasts for Q2 are coming down, then what about the earnings picture?
Well, it's, first of all, there's always winners and losers. There's a lot of companies in sectors that have no correlation to inflation. Technology is one example. And there's many groups highly correlated to the rate of inflation, like basic materials and energy. We're not talking about overall inflation going negative. It's actually that it's going towards 2%. So there's still plenty of companies that are getting price. And as you know, the biggest pressure on many companies' margins has been wage pressures. That's cooling a lot, and gasoline's cooling, and that's really helping consumer wallets. So I think it's pretty complex, but to us, if the global economy is picking up and earnings delivered have already suggested 270 for 2025, I still think we're maybe going to be closer to 280 next year.
Tom, if markets tend to lead the fundamentals and we've run up here, to let's say 21 times forward earnings, why would improved earnings relative to expectations now lead to multiple expansion, on top of what we've already had?
It's a fair question. It's really the composition of what contributes to the gains, because if you look at S&P forward, it is high. I think forward earnings multiple is like 19, but the median is 16, and the median PE in the Russell 2000 is actually 11 times. So I think that there are going to be many stocks that can re-rate towards 20, but the PEs many stocks that are at 27 PE, I mean, they could increase in their multiple, but I think there'll be a lot more juice in the 16 multiple going to 20 than there is 27 going to 28.
Hey, finally, Tom, 5 days in a row, S&P headline index and breadth have diverged. We haven't seen that kind of streak since the late 90s. Are we going to start assembling lists of analogs to the late 90s, and is that a good thing?
Carl, the late 90s didn't end well, so I think if this is going to look like the late 90s, then investors do have to be really preparing some portfolios that are appropriate for that, and that that in the 90s, late 90s, that meant to really be patient with value, and then of course be ready to exit the high momentum. In some ways, I think the skepticism that exists today, because I was an analyst starting in '93, so I saw the '90s. There was a lot more ebullience back then, and a lot more people who didn't think stocks could ever go down. I think there's a lot of top callers today. So for me, this feels a lot more mid-cycle. And I know it sounds surprising, but there's just too many top callers, especially among our institutional clients.
All right, guys, this is the part of the video where I'm going to break down the stocks that were mentioned in the CNBC clip. Today they talked about the S&P 500, the NASDAQ, the Dow, and the Russell 2000. So I'm going to briefly break down those stocks. Recently, the analysts have been making a lot of long-term calls, so I thought we'd take a step back and make every single bar 1 week instead of 1 day. So this is the 45-week moving average in blue and the 200-week moving average in green. So right off the bat, the S&P 500, you can see we've been on an amazing run, and now we're starting to look top heavy. We've had 2 consecutive weeks with topping candles now showing that we tried to go higher and are now getting rejected. You can also see that we've got quite a distance to that 45-week moving average and the 200-week moving average. You can see many times in history we've come back to the 45 and the 200-week moving average. That does not mean that the trend is over. That just means that we need a nice healthy pullback because the run has gone on too fast or for too long. That's kind of where we're at right now, guys. I think we need a sideways consolidation at the very best to maybe even some type of pullback, because by the day we're getting farther and farther from these moving averages, which we all know the farther we get away from them, the faster we're going to come back to them. So I'm not putting any new money to work right now. I think we're going to have a pullback in the next few weeks to next month or so. On to the NASDAQ, you can see we've also had 2 consecutive weeks with topping tails, so we rejected going higher. We are still a huge distance off that 45-week and the 200-week moving average, guys. We touched them not too long ago, and we've gone on such a strong, epic run that it makes sense that we need a little pullback. At very least, we need to start going sideways. A lot of these broad market ETFs are going to need the same exact type of pullback. They've been incredibly strong this year. Here's the Dow Industrial Average. It's holding that 45-week a lot closer. You can see the gap is a lot smaller, so this one's actually looking pretty healthy. It's holding those 45-week moving averages, the long-term moving averages. The gaps are not as big as the S&P 500 or the QQQ. We also have some very nice support that was resistance back here if we do keep falling, back in the 370 level, somewhere around there. But guys, this pattern is looking very nice and healthy. The Dow Jones Industrial Average moves a lot slower than the S&P 500 and the NASDAQ, but nonetheless, it's still consistently grinding higher. And those long-term moving averages keep up, so that means there should be a lot less downside if we do start to head down. The Russell 2000 small caps have been everywhere. Up, down, major moves. But we've basically been in a channel for the last several months, and now we've been working our way out of it to the high side. We're making the high side of this channel a nice support zone. You can see we come back and touched it almost to the penny right here, and we're going back to the high side. I think this is looking pretty bullish. We also have the long-term moving averages catching up nicely and supporting this move. So the Russell's actually looking the most long-term bullish out of all the charts right now. I hope you guys enjoyed the video and the breakdown. If you did, smash that like button and subscribe if you haven't already, and I'll catch you in the next video. Peace.